In 2002, this company admitted it overstated profits by more than $11 billion. At the time, it became the largest accounting fraud in United States history. The fraud did not involve shell companies or offshore accounts. It involved a basic accounting decision approved inside the finance department. That decision turned routine operating expenses into reported profit. This is how WorldCom committed securities fraud through everyday bookkeeping. The rise. WorldCom began as a small long-distance phone company. During the 1990s, it expanded rapidly through acquisitions. It bought dozens of competitors. Revenue increased. Market share grew. Wall Street rewarded size and consolidation. Executives were praised for building scale quickly. By the late 1990s, WorldCom was one of the largest telecommunication companies in the world. But the appearance of growth hid a growing weakness: the pressure. The acquisitions left WorldCom heavily indebted. Interest payments were significant. Cash flow was tightening. At the same time, competition in the telecom industry increased. Prices fell. Demand slowed. Despite this, analysts expected WorldCom to meet earning targets every quarter. Missing those targets would have serious consequences. The stock price would fall. Debt covenants would be violated. Executive compensation tied to earnings would be lost. Management faced a choice: report lower profits and accept the consequences, or use accounting to maintain the appearance of growth. They chose accounting. The decision. WorldCom's largest recurring cost was known as line costs. These were fees paid to lease network capacity from other telecommunication companies. Under accounting rules, line costs were operating expenses. They must be recorded in the period they were incurred. WorldCom changed that classification. Senior finance executives directed accounting staff to classify line costs as capital expenditures. Instead of appearing as expenses, the costs were spread across future periods. This single decision had an immediate effect. Expenses disappeared from the income statement. Reported profits increased. Nothing changed operationally. Only the accounting had changed. How the fraud functioned. The reclassification was carried out through manual journal entries. These entries lacked proper documentation. They were approved internally without meaningful review. They were repeated quarter after quarter. Internal accounting staff noticed irregularities. They raised concerns about the legitimacy of the entries. Those concerns were dismissed. Internal controls that should have stopped the practice failed. Oversight was weak. Management pressure discouraged escalation. Internal auditors relied heavily on information summarized by management. They did not review the underlying entries in sufficient detail. By the time the fraud was uncovered, more than $11 billion in expenses had been properly capitalized. When the accounting became fraud, this was not an accounting mistake. Executives knew the treatment violated accounting standards. Despite that knowledge, they continued to file financial statements that they knew were false. They submitted misleading earning reports. They provided inaccurate information to investors. Under federal law, this constituted securities fraud, false filings, and conspiracy. WorldCom's stock price was supported by information executives knew was not true. Discovery. This fraud was uncovered internally. WorldCom's internal audit team began reviewing unexplained accounting entries. They found unsupported journal entries and missing documentation. When the findings were presented to the board of directors, the scale of the fraud became impossible to ignore. Public disclosure followed shortly after. Collapse. The market reaction was immediate. Investor confidence collapsed. In July 2002, WorldCom filed for bankruptcy. At the time, it was the largest bankruptcy filing in United States history. The consequences were severe. Investors lost billions of dollars. Employees lost their jobs and retirement savings. Shareholder value was effectively wiped out. The company was later restructured, renamed, and sold. Criminal charges and sentencing. Federal prosecutors charged senior executives involved in the scheme. Bernard Ebbers, WorldCom's chief executive officer, was convicted of security fraud, conspiracy, and filing false financial statements. In 2005, he was sentenced to 25 years in federal prison. Other executives pleaded guilty or were convicted and received prison sentences. The convictions reflected the scale and duration of the fraud. What actually happened? This was not a complex financial scheme. It was a simple accounting decision applied repeatedly. Move expenses off the income statement. Report profits that did not exist. Delay the consequences. The accounting rules were clear. The violations were deliberate. WorldCom did not fail because technology changed or markets collapsed. It failed because executives chose deception over disclosure.